Well, hello everybody. How are you all doing? This is Dave Cutler coming back at you. And today what I want to do is talk to you a little bit about some common financial mistakes that people are making. Every single day we see this all the time, Janine and I both. The first one that we're going to talk about today is getting a big tax refund. This is a very common financial mistake people make that could end up costing you as much as $1 million over your working lifetime. Just by getting that big tax refund. A lot of people have an emotional attachment to getting that big check every year, but let me spell out how it really affects you. Imagine you get a $3,000 refund every year. We'll break that down, divided by 12. That's $2,500 a month that you're willingly giving extra to the IRS so that they can just hand you that money back at the end of the year, and interest-free. I'm sorry. The question is $250 a month is a good chunk of change. That's a car payment for a lot of people. Could you use that money right now to pay down debt or to potentially fund an IRA? That $3,000 a month into a Roth IRA for just 7 years between the ages of 22 and 28. If you never put another dollar into that investment by age 62, you'd have upwards of $1 million. So it's a pretty costly decision to not have a certified professional take a look at your taxes and your budgeting and make sure that you're not sending extra money to the government that you don't need to be. The second mistake people make that I hear a lot of people doing is everybody wants to start saving money for their kids' college education. It's usually one of the first questions that we get asked is, what's the best way to save for my kids' college? But the first thing that I'll ask is, well, how much are you putting away for yourself right now? And then, of course, we get the blank stare because they don't really know or they're not putting anything at all. Quite simply, I got to say that your kids can finance their college education, but you cannot finance your own retirement. And that's a huge burden to put on your children, because if you save money for their college and put them through school and forego saving money for yourself, well, who's going to have to support you later on in retirement when you don't have enough money for yourself and you can no longer work? Well, that's going to be the burden that your children are going to have to take on now to support you in retirement. And you know how hard it is just to make ends meet today, trying to support your own family, let alone having to support your parents as well. So don't put that burden on your children. Make sure that you're putting away at minimum 10% of your gross annual take-home income every single year away for your own retirement. 15% would be much more would be ideal, so that your kids don't have to worry about your financial situation later on down the road in retirement, and they can use the money that they're making to support their own families. The third mistake that I see a lot of people make, people say, well, I've got money in this bank account here, and I've got money in checking account, or I have money in an IRA or retirement accounts. Well, I never see people that have a dedicated emergency fund. If someone lost a job and you were out of work for, say, maybe 2, 3, 4, maybe even 6 months, take a look at the job market today and how hard it is to find another job, especially if you are currently making a decent income now of $40,000 or more. Those jobs are very hard to come by. So if it takes all of that $40,000 salary for you to maintain your current lifestyle, and you were out of work for 3 to 6 months, how devastating could that be to your family? So it makes sense to start putting some money away now for that rainy day, 3 to 6 months of after-tax income, so that if something does happen like that, and believe me, if you think your job is safe, especially if you work in front of a computer, you're sorely mistaken. Jobs are going overseas left and right now, and especially with the economy being down, a lot of people are being affected. The fourth mistake that we see a lot of people making is nobody has a budget. People are constantly telling me, well, it seems like we make plenty of money, but there's never any money left over at the end of the month, and we don't understand where it all goes. Well, Starbucks and McDonald's are two of the biggest culprits for that. But the main thing is that people just don't budget out money to spend on a weekly or monthly or even a daily basis, so that you can keep track of everything that's going out. One of the easiest ways to do this is to actually get a budget worksheet made up, something that you have put together by any qualified financial professional. We put budget worksheets together all the time for our clients, and track your spending over the next 90 days. Save your receipts and see where that money goes. You will be absolutely shocked. I've seen many families that we sit down with that are blowing through as much as $1,000 a month or more that just goes out the door completely unaccounted for, and that's $12,000 a year. That's a good amount of money every single month to just be blowing through and not accounting for it. The last one here that we see is a lot of people think that they're protected through work with their life insurance program, especially people with kids and a big mortgage, but they don't have any personal life insurance, and they just kind of think, I signed up for it at work, everything is okay. A problem is that employer paid coverage is typically very small, anywhere from $10,000 to $50,000. Anything above $50,000, generally your employers are going to have to pay taxes on those amounts, so they try to keep it at $50,000 or less. That's 1 year's salary for most people, and how long is that really going to be able to take care of your family for if you make more than that? The other problem with employer-covered, group programs is that your employer pretty much controls everything about the program. They can cancel it any time. There's many restrictions that they can put on it that can cause these plans to not pay out. For example, many of these policies have provisions in them that state that they will not pay out the policy unless you die on the job, or that you have to maintain a certain number of hours every single week in order for these policies to even pay out. So we've heard a lot of horror stories in that area. Buying your own personal insurance, especially with rates being as low as they are nowadays, it's a no-brainer. For a 35-year-old male, we could put a $500,000 20-year level term coverage for as little as $35 a month. So what are you currently spending $35 a month on right now that's more important than making sure you have a program in place that completely protects your family in case something tragic were to happen to either you or your spouse, or God forbid both of you? So those are some common mistakes people make, and you definitely want to try to get your financial house in order, because it's one less thing to have to worry about later. That's where spending 20, 30, 40 minutes with a competent financial planner such as myself or Janine can definitely take care of that for you. Get rid of those things taken care of so you don't have to worry about them later, and know that you have somebody in your corner that you can trust and that you can talk to in case anything comes up or if you have any questions. Thanks for spending some time with me today. Please feel free to leave any comments below. If you have any questions or concerns, I'll be more than happy to answer those for you. And outside of that, I hope you have a great week, and we'll talk to you soon. Bye-bye.